Hi everybody, it is Bob Iacchino from the Pure Exposure Growth Series and Path Trading Partners. And I wanted to make a quick video for you guys with what's going on in the markets today. I'm talking to you at about 5 after 2 Central Time, and the markets are still pretty beat up. As I'm looking at, let me give you kind of exact levels while I'm talking to you. The crude oil's down 3 1/3%. Gold is still up about 0.5%, got as high as like 1691. As I talk to you right now, it's about 1657. We've got the Russell down about 2 2/3%. We've got the Dow down about 2 3/4%. Wow, it was a lot worse when I first decided to make this video. Down 3% or so in the NASDAQ, and the S&P down about 2 2/3%, 2.5%, right around there. All of those were down near 4%. Crude oil was down near 5%. Copper was down about 1.5%. Right now we've got copper down about 1.25%. But I asked Jay Soloff to make a video to talk about the Apple trade that he discussed on our live stream, February 18th, Pure Exposure Growth Series live stream that we had on Tuesday, February 18th. And the link is down below if you want to watch that replay. I really think you should, because we talked a lot about these kinds of things happening. It was a black swan show. So this 2-day sell-off has been one of the biggest ones in years. And again, gold approaching 1,700. We haven't had that in quite some time. Even the yen, which is a flight to quality currency, up over 1% on its highs today. So Jay's going to talk about that trade. And you'll notice, again, his part is pre-recorded. He recorded this on Saturday before knowing any of this was going to happen. You'll be able to tell from watching him describe the trade that he didn't know this sell-off was going to happen. And he describes how you could get into the trade now and where those strikes should be. If you're going to sell the put spread that he's talking about, you have to adjust the strikes toward where the actual stock is now. So he goes through that, but he also goes through where he would have taken profits in the days subsequent to the live stream when he talked about that trade. And then he also brings up how he didn't need Apple stock to go down to take advantage of this trade. And at expiration, all he needs is above the lower strike. So he's going to give you a lot of good information on this particular trade. It worked for him already. It still could potentially work in that style. Just be careful if you don't understand the trade. I wouldn't recommend you putting it on. I'd recommend that you reach out to Jay Soloff at Investors Alley and get his opinion on how to put that trade on. But before I play that Jay video, I want to talk about coronavirus really and what's going on with the markets, because we're now starting to reprice to what I thought should have happened a while ago. I've had several TV spots. You can look them up, or you can reach out to me and I'll send you a link where I said that the stock market is not pricing this in correctly, simply based off the fact that yields were pricing in a much bigger deal while the stock market was making new highs, and commodities were getting sold while the stock market was making new highs, and that something had to give. And it was more likely that stocks gave and caught up to yields and commodities than it was the other way around. And now we're starting to see stocks catch up. So we're obviously going to be watching the coronavirus headlines very closely, but I want to give the screen over to Jay Soloff because he did record this for me. I thought about potentially kind of saving it since Apple and the stock market in general got hit so hard. I mean, again, I mentioned how much everything else was down. The stock 600 in Europe at the European close, 595 of those 600 stocks are down. So even stock pickers aren't doing well today. But we're raw, we're honest, we're real, so we're going to put the trade out there, and you'll be able to see how Jay had already theoretically taken profits from this trade prior to the sell-off, but that this doesn't sort of exclude the trade from still being profitable at expiration. So I'm going to go ahead and play that Jay video now. Jay, take it away.
Hey everyone, it is Jay Soloff from Investors Alley. I'm going to take a closer look at a trade I recommended on the Pure Growth Exposure series last Tuesday the 18th. So let us take a closer look at the trade. All right, so what we're looking at here is the options change for Apple. So before I talk about the trade, let's talk about the setup a little bit. So what was happening at the time was Apple had just announced the night before that they were going to see some negative sales impact from the COVID-19 coronavirus in China. It was going to hurt their sales for this quarter, and the stock was down quite a bit in after hours. So as we were heading into the open, the trade I was looking at was a credit put spread in Apple or selling a put spread in Apple. And there's a couple reasons why you might want to do something like that. So let's talk about that first. First off, when you do a credit put spread, you don't necessarily need the stock to go up. That's nice, makes it easy, but the stock can actually go sideways or even go down a little bit. And what you're benefiting from there is volatility in the puts, which happens because the stock may be down quite a bit, like before market open, for instance. So if it opens down, you have a lot of people potentially rushing to buy those puts, and you have the market makers setting those put prices higher. So we want to go the opposite. We want to sell those puts. So that's one thing. The other thing is that if you think this trade is temporary, then you're not risking all that much by selling a put spread. You don't think it's going to blow through those strikes, and particularly you don't think it's going to blow through those strikes and stay there. And that's because if you think about something like Apple, well, let's look at a company like a steel mill, and maybe they get their iron ore from China. Well, a steel mill needs to produce a certain amount of steel. They can't wait a couple months for that iron ore shipment, so they may go to, let's say, Canada and get the same exact iron ore. Maybe it costs a little more, maybe it costs a little less, but they're going to make that switch because they need that iron ore, and it's a commodity, right? They can switch it out equally. Well, an Apple iPhone, let's say people are waiting for the Apple iPhone 11. That's the phone they want. If they have to wait a month or two to get it, most likely they're going to do that. They're not going to say, oh, I'm going to get a Samsung Galaxy. Maybe to some extent, there may be a few people. For the most part, people are going to wait for that product because that's the phone that they want. So a negative sales impact from Apple is most likely going to be a temporary thing. So if you think it's going to rebound or not fall too much, then that's a good situation where you might want to say, all right, I'm going to sell credit put spread. I'm going to take advantage of these expensive puts by collecting a credit, by selling a put spread. So what I said at on the show on Tuesday 18th was that wherever the stock was going to open, we wanted to go about $5 lower. So at that time, it was about 317 on the open. And we're looking at the February 18th puts here. So 317 on the open. So 312.50 was the closest strike. That is $5 lower. You could sell that thing for around $5. Now, why do you buy another strike lower? Because that's what I was recommending, going about 5 more strikes down and buying a strike. That's simply protection and a way to cap your margin. So we buy back the 307.50. So we're selling the 312.50. We're buying the 307.50. We got about $1.55. That's our max gain on the trade. Max loss is the difference between the distance between the strikes, which is $5, minus whatever credit you got. So in that case, it's about $3.45. So you might be saying, well, why do I want to collect $1.55 when I'm risking $3.45? Well, once again, this is a higher probability trade because you don't necessarily need the stock to go up. It can go down all the way to $3.50. It could just move sideways. Wherever it goes, as long as it doesn't blow through that bottom strike, you have a good chance of making all or most of that credit. Plus, you expect volatility to go back down as the market normalizes, which is also good for this trade. And in fact, the next day, Apple was up to about 323. You could have closed this put spread the next morning for about 95 cents. So if you were to say, hey, I'm going to make this a quick one, I'm going to take as much as I can right away, you could have gotten about 60 cents on that trade overnight. And what that means, if you look at it in terms of cash at risk, is that you could have made about 17% on your money in less than 24 hours. I will take that all day.
Again, my thanks to Jay Soloff, who is the Chief Options Strategist at Investors Alley. You can find him at investorsalley.com. If you want to ask him questions about this particular trade or anything else, I'm sure he'd be happy to talk to you guys. And then last but not least, where can this all go? Now, I don't think that this is a global depression. It does seem to be a pandemic, but I'm not a medical official. I'm not a part of the World Health Organization or the Chinese medical establishment or even the US medical establishment. So I don't know. All I know is that when I don't know, that means the investing community doesn't know. And the worst thing for markets is uncertainty. So when there was about 2,000 cases total with only a few hundred fatalities from COVID-19, which is what the coronavirus is called, Goldman Sachs said there was going to be a 1/10 to 2/10 hit on global GDP. based off those numbers. It's got to be worse. There, in my opinion, is zero chance China can reach in the short term the phase one trade deal purchase agreements, the things that they agreed to purchase from the U.S. To me, there's zero chance that they can do that now. Maybe it's delayed. Maybe it's not done at all. We don't know. Trade is now off the table in terms of a discussion point, and trade was going well. So we already had a slowdown happening, and now we've got this. Does that mean stocks have more to go? Maybe. I'm not ready to buy stocks just yet. If you watch some of my old TV spots, you'll see that we said when we're buying stocks now, after they go up a little bit, we're taking that money and buying protection. This is some of the things that responsible active investors do during extended times like this. So check out the replay of the show. I had said on the show that our next live stream was April. Well, due to demand, we're actually going to do a March show as well, which is going to be, I believe, March 16th. I think that's a Tuesday as well. Don't quote me on that part of it, but March 16th, we'll have another Pure Exposure Growth Series live stream. Already got two committed guests, Amelia Bordeaux and Carly Garner, who are both really, really good. So we look forward to seeing you guys there. Check out the replay. Thanks to Jay Soloff, and I'll see you guys in the next video.